Welcome back to our series on business model design. I'm Roland Umlauft, your strategic CFO specializing in tech and innovation. In our last three videos, we've explored the foundations of the four-pillar business model framework. We've been deep diving into value creation and pricing. And today we're going to talk about another topic and one that is really close to my heart, unit economics. You see, a lot of companies scale revenue, they raise capital, they generate a lot of buzz, but often the underlying math of each customer, each product, each transaction, it just isn't profitable. And that growth that they're creating actually becomes a house of cards. Think about the early days of food delivery startups, for example. So they've attracted millions of users, they've processed hundreds of millions of orders, and they've raised billions in capital. But for a long, long time, the cost of actually delivering a single meal, and that includes, the rider pay, direct customer support, payment processing cost, well, this was actually consistently higher than the revenue share that they got on that order. A lot of times they were losing, $1, $2 on each and every meal delivery. This obviously is not something sustainable. And of course, we need to keep in mind the amount of money that they spend in the first place on getting customers on their platform. So instead of, making your business more profitable by making more deliveries to more customers, they were actually losing more and more money every time they grew their customer base and started delivering more orders. This is exactly what unit economics reveals. It's that crucial level of profitability at the most, granular level before even considering things like customer acquisition costs or any kind of, massive overhead. If your business model is not profitable at the unit economics level, then you are in trouble. So what are unit economics? At their core, unit economics really analyze the revenues and costs associated with a single, unit of your business. This unit can be, anything from a single customer, a single product sold, or a single, monthly subscription. It's about understanding this profitability of your core business engine at that transaction level. So without a firm grasp of your unit economics, you're basically flying blind when it comes to things like pricing, when it comes to sales strategies, or you want to give a discount on something, other things like product development or even fundraising. This is the ultimate reality check for any business model. So let's take a look what should go into your unit economics calculation and what should not. Let's start with income. You probably have heard about lifetime value or LTV. So this is the total revenue that you're basically expecting to generate from a single customer over the entire relationship with your business. So to estimate lifetime value from, let's say, a subscription model, what you basically do is you take the income from one period and you divide that by the average churn rate percentage of that period. What is a churn rate percentage? That is basically the percentage of existing customers that you're losing in each period. Churn is a little bit tricky sometimes because it's not always linear. You cannot just rely on simple averages because they will give you the wrong results. Instead, you will need to aim for methods like cohort analysis, where you're tracking a certain group of customer throughout their life cycle. Basically, you're grouping together customers that signed up at the same time, and then you see how this group behaves over time. And this allows you to see their cohort-based revenue and churn behavior on a timeline. Let's say we know how much money we're expecting to make from each customer over the lifetime. Next, we need to subtract any direct costs, such as customer service, cloud hosting, payment processing, or the cost of, our delivery rider from our earlier example. Do not forget about implementation costs and onboarding costs. This can be significant for a software business. Once we subtract this cost from our income, we get to net LTV, or often called true LTV. This is the total net income that you're going to generate from each customer over their life cycle after all the costs that you have incurred for providing the product or the service to this customer. Okay, let's assume that we are able to estimate our net LTV and we know how much money we're getting from our customers over the lifetime. Let's now compare that value to how much it actually costs you to acquire this customer in the first place. So this is your customer acquisition cost, or often called CAC. You'll want the net LTV, your net lifetime value, to be significantly larger than your acquisition cost for your business to be making any money. It sounds easy in theory to measure CAC, but especially in a B2B setting with, let's say, a more complex sales cycle that can be, long, this is not trivial. And I probably should make a couple of videos specifically on this topic. Let me know what you think about this in the comments. Today, I'll give you a quick overview of what you typically should include and a couple of practical tips. So in your CAC, you should definitely include all sales and marketing expenses that are directly attributable to acquiring new customers. This means not just advertising spend, but also things like salaries and commissions for your sales and marketing teams, things like software tools and platforms, so your CRM, your marketing automation, your sales enablement tools. Don't forget about your travel expenses or entertainment expenses for sales. This can be massive. Costs for going to trade shows, conferences, and any other type of lead generation activities, or any other overhead that is directly related to acquiring new customers. If you're taking this all-in approach, don't worry too much about direct versus indirect attribution. I've seen marketing managers arguing that their brand positioning spend should not count towards CAC, and that's fair enough. If you go the all-in route, just include it. If you decide to use a leaner definition of CAC, so for example, just digital spend for leads, and treat the marketing teams, the CRM platforms, etc., as fixed cost, that's fine as well. Both approaches work for me. It all depends a little bit on your acquisition channels, your business model, and what gives you the better metric. How are you going to deal with longer sales cycles? In B2B, sales cycles often span months or even years. This means that what you're spending today on marketing and sales might not yield a customer today. It might yield a customer in the next quarter or maybe in the next year. How can you come to a good level of CAC when you have these really, really long sales cycles? Consider calculating your CAC based on the marketing and sales spend from the period when you typically would acquire the leads, and not when they were closed as a sale. Now, you can use your average time to close as a lag time just to kind of keep it simple. Or if you have really good data and you can attribute each customer and you know how long it took to sign them up, then do some calculations to adjust here. But that can be getting very, very difficult very quickly. So my tip would be just use your average time to close, put in a lag, and you're still going to get better results than using same period costs. Finally, try to segment your CAC and your entire unit economics in line with your customer segmentations, your sales channel, and your product. Segmenting by these factors will provide you a much richer insight into your unit economics and into where your acquisition efforts are more efficient and where you're having the better payoff between your level of CAC and your true or net LTV. So what's a good LTV to CAC ratio? A widely accepted rule of thumb, especially in SaaS and subscription businesses, is an LTV to CAC ratio of 3 to 1 or higher. This means for every dollar that you're spending to acquire a customer, you should expect to generate at least $3 in lifetime value after having paid for all the direct cost from these customers. However, this is a benchmark. It's not a rigid rule. The ideal ratio can vary significantly by industry, growth stage, your fixed cost structure. We're going to talk about fixed costs in the next video, so stay tuned for that. And payback period, right? By payback period, I mean how quickly you can recoup your CAC. A shorter payback period allows for a slightly lower LTV to CAC ratio, and is generally considered better. So as you can see, there is no general rule for this ratio, but you should at least aim for 1-to-1, because anything below 1-to-1, you're losing money. So to effectively manage and optimize your unit economics, you need clear visibility. And this is why you should absolutely implement a unit economics dashboard. This kind of dashboard centralizes all your key metrics in one place, and it will give you a long-term customer view and an insight on the immediate product profitability. So it should include things like the true LTV calculated with the proper churn assumptions and through a cohort analysis. And this metric, again, will tell you the total net value of a customer over their entire lifespan after subtracting all the direct service costs that you have with this customer. Second, the gross margin per unit. This reveals the immediate profitability of your core product or service delivery before acquisition costs. So this would be income minus cost for, let's say, each food delivery, for example. Whereas LTV, on the other hand, would show the amount of money a food delivery platform is making from each customer over the lifetime. Next, you should be tracking your customer acquisition cost over time. You should be tracking your CAC payback period. And finally, the churn rate broken down by cohort, if you can do this. A well-designed dashboard allows you to track, any kind of trends, identify bottlenecks, and make these data-driven decisions to improve the profitability and scalability of your business model. So this is not just a finance tool, it's a critical tool for product, it's a tool for marketing, sales, and company leadership to ensure alignment on these sustainable growth targets. Now, I also want to discuss a couple of common pitfalls again, this time aimed at unit economics. I've seen many companies stumble on their unit economics. So ignoring implementation costs, for example, is a very common fallacy where these implementation costs can be quite significant. And if they're not included in your LTV calculations, you're dramatically overestimating your customer value. Not segmenting your unit economics, right? If you're assuming that all customers and products have the same unit economics, you're not going to be able to identify the channels, customers, products that are giving you a better profitability than others. Maybe you're loss-making on some product line. If you're throwing everything together, you will not be able to make these distinctions. High-value enterprise clients versus small businesses, they will have very, very different LTV to CAC profiles, for example. Some companies have growth targets that come at all costs, leading to often negative unit economics. Obviously, you can do this in the short run. This cannot be a long-run strategy. So if you are pursuing these, very, very strong growth targets with that are driven by negative unit economics, you need to have a clear strategy in place on how to turn those unit economics positive for the long run in order to create a sustainable business. Lack of real-time tracking. So if you're not having this kind of dashboard that we've discussed earlier, or any kind of consistent reporting to monitor any changes in lifetime value, for example, or in your CAC or in your churn rate, then you're not going to be able to react to any kind of external market changes, for example. And you're not going to know if a product that you thought was profitable has no longer these profitability characteristics. Finally, misinterpreting churn. So if we're not adjusting for nonlinear churn, or if we're failing to break down churn by cohorts, this will give you a very inaccurate picture of your lifetime value forecast. Often we're also underestimating our CAC, especially in B2B, if we're forgetting to include all sales and marketing costs, especially things like travel costs that can be very significant. Or we're not accounting for these super long sales cycles in attribution. This can lead to very skewed estimates of your CAC. I'm again providing you with an audit tool that you can run for your own business, and hopefully this will help you to assess your situation. The audit tool will help you to assess your net LTV and churn calculations, as well as your CAC calculations. Additionally, it looks at CAC payback period and your gross margin per unit and helps you revisit those. LTV to CAC ratio obviously is important, and the benchmarking compared to your numbers. And then finally, unit economics visibility. So how do you assess unit economics, and are you revisiting your unit economics strategy on a regular basis? All of these are part of the self-assessment tool. I invite you to download it and fill it in. Let me know any kind of outcomes or questions you have. Happy to get those comments. Now, to conclude on the food delivery example from earlier, some companies from that sector have been addressing their unit economics head on. They focused on, first, operational efficiencies. So things like software that gives you better routing. So you're faster at delivering, you're reducing your cost through better algorithms of routing, right? They've optimized their pricing. So customers pay more, they pay higher fees, and also restaurants pay significantly higher fees nowadays than in the early days of those platforms. And the biggest and most impactful change that they've done is they've come up with these subscription-based models. So they're inviting you to pay a certain amount of money per month, and then they're waiving your portion of the subscription fee. This basically has two effects. First, it creates a level of predictable income for the companies. And secondly, it boosts customer loyalty. So you are staying with the platform, they're making more money from you. Finally, they've been diversifying their offerings into other segments other than just restaurant food. So they're now doing supermarket delivery, pharmacy, any kind of other products that you can think of, flowers, etc. With all these changes, they ultimately managed to increase these ultra thin per margin levels a little bit to find a path to sustainable growth. They're not still super profitable on each transaction, but at least they are now profitable, and having these millions of customers and this very high volume multiplied with even small marginal profitability gives them significant income and gives them enough income to pay for a large part of their very large overhead costs. This wraps up our deep dive on unit economics, the magic that basically makes your business sustainable, and this vital component of successful innovation. Understanding unit economics will empower you to build out your venture, not only to grow it, but to ultimately generate a profit. So in the next chapter, we'll be talking about fixed costs and capital expenditure. So stay tuned for that. And as always, please hit that like button, subscribe to the channel, share it with your fellow innovators, drop your questions and insights from this chapter in the comments below. I love hearing from you. Thanks for watching, and I'll see you in the next one.